You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 6th of August 2024, and I'm joined today by my co-host John McEwen. In this week's episode, we'll be discussing Greggs, Next, Diageo, Haleon, Games Workshop, and our US company of the week is MasterCard. John, should I start us off with our favourite pasty maker?
Yes, absolutely.
So, Greggs have come out with their interim results and they've reported a 13.8% increase in revenue to 960 million, with company-managed shops delivering like-for-like growth of 7.4%. The performance was driven by the expanding estate, ongoing menu development, and higher evening sales. Underlying profit before tax rose 16.3% to 74 million, ahead of expectations. Revenue growth and easing cost inflation helped margins rise from 7.5% to 7.7%. Free cash flow rose from 19.8 to 57.4 million, driven by higher profits. Net debt, including leases, was 185.5 million at the end of the period. 51 net new shops were opened in the half, and Greggs remains on track to open 140 to 160 net new shops over the year. An interim dividend of 19p was declared, up 18.8%, and the shares fell 1.8% following the results. We covered it in a bit more detail last time, but quite a lot of the increase partly is from the number of shops going up, which they're doing very well at, but also they've been expanding the opening times. And we did comment last time that that's a lever that they could only pull once. It looks like that might not be the case, because apparently just under half of Greggs shops now serve food until 7 p.m. or later, but that means there's still over 50% that don't.
Yeah.
In terms of the valuation, the business trades at a forward P of 20.6, and that compares to a 10-year average of 22.9. And the prospective dividend yield is 2.4% compared to a 10-year average of 2.6. I don't think there's really anything to criticize in these results. I think they're absolutely excellent. It continues to deliver despite our comments about it sort of reaching saturation. That being said, you do always make the comment that it does feel a lot less saturated in the south, and I think that seems to be reflected in the store openings. I just have the same issue with it where, to me, it does still feel saturated. I think these results are excellent, but I also think it's quite expensive. And given that, I just wouldn't be comfortable paying 20 times earnings or 21 times earnings. But the results themselves I can't fault, and it has been doing this consistently since it came out of COVID. So I can see why someone else would like it. What about you, John?
Yeah, I mean, very similar. And as you say, what we'd outlined before with it, it's certainly not a cheap company now. And I think it's one that I would have been more likely to pay up a few years ago for, when I did feel it was less saturated. Yeah. And at 20 times earnings, I don't think I'd be brave enough. I think it's very high quality. And I think as well, you certainly can't knock the numbers that it's put up, but it's that fear of the saturation and the growth going forward. And I don't see it as a company that you could imagine moving abroad. I don't think the French would appreciate Greggs in the same way that people in the north and certainly people in the rest of the UK do. So I don't know where it kind of goes from here. And at 20 times earnings, it's not something where I'd be, kind of willing to pay up and find out. I think it would be interesting for us to cover it. And it's the sort of thing that maybe you're brave enough in the fantasy portfolio, but I think in real portfolio, not for me.
Should we move on to a business then that may be good enough for the real portfolio?
Well, yes, again, it's one that keeps on beating the forecasts. So it's Next, the high street retailer. They have their Q2 trading statement out, with the group reporting first half sales growth of 8% and full price sales growth of 4.4%, compared with the 2.5% that was expected. And second quarter full price sales rose by 3.2%, and that was compared with minus 0.3% that was expected. And online and overseas performance, the main driver behind the growth, and retail was down 4.7%. Surplus stock was up 21% on last year, but down 5% on 2 years ago. And clearance rates are in line with internal forecasts. Guidance for 2.5% growth in full price sales over the second half remains in place. And for the full year, total sales and full price sales are expected to be between £6.2 billion, which is up 6%, and £4.9 billion, which is up 3.4% respectively. Profit before tax guidance has been raised from £960 to £980 million. And on the statement, the shares were up nearly 8%. In terms of valuation, Next has a market cap of £11.2 billion and trades at 15.5 times forward earnings, compared with the 10-year average of 13.8, and it yields in the region of 2.5%. Again, I thought these results were excellent. I don't think there's anything you can knock apart from the retail, which is sort of in-store retail, which was down 4.7%. I think the group, we have seen that for a while, and the group is strategically moving away from sort of town centres. It's of the physical retail, it seems to do better in the sort of shopping centres and more sort of kind of warehouse type setup, and it is transitioning towards that. And then you're seeing it. It's phenomenal for a company on the high street to be able to have the sort of online business that Next has, and how slick their operations are. And I know we've talked about the systems that they do sell and sort of let other retailers use. So I thought these were phenomenal results. I suppose to a degree, when you compare it with the other retailers, it is reflected in the valuation at 15.5 times forward earnings. For a high street fashion retailer in the UK, that is very high. And I guess it does have it's a very difficult environment overall, and it's setting difficult comparators for itself. How big can Next grow in the UK? I don't know. I probably would be on the fence about whether I would pay up 15.5 times earnings for it, but it's certainly proving its quality, and since we've been covering it, has consistently delivered. And I think that's reflected in the share price too. Sam, would Next be in your portfolio?
I don't think it would at this valuation. There was a point maybe a year or two ago where I was very, very close to adding it and just didn't, which was in hindsight not the best decision.
Do you know what's over the past year share price performance of Next has been?
I know it's been good.
36%.
36%, right? Oh, cheers.
It's all right. I mean, I could say the same thing, but
yeah, I mean, we've covered it a number of times on the show. I've really liked it for a long time. It's one of them businesses. It's always been on the watch list, and I've just never quite pulled the trigger on it. I think it's because historically I had Boohoo, and I know it's a very different business, but I just didn't like the thought of adding more UK retail, even though it's a very, very different and much better business than Boohoo. Yeah, I think the results are excellent. I think the valuation's justifiable at 15.5 for the quality of the business. And I know it's maybe a bit pricier than some of its other UK retailers, but it's a better business. And I don't think it's at that much of a premium. I think as well, if you were to compare it to, for example, Inditex, which is listed over in Spain, it's cheaper than Inditex, and I think it's a better business in terms of like the proportion of online sales, the results it's consistently delivering. So I think an argument can be made for it. But yeah, I really, really like it. But if I think back to a couple of years ago when we were first covering it, we've liked it for a number of years, but it has gotten more expensive. I remember we were covering this at sort of 11, 12, 13 times earnings and saying how cheap it was. And we're now no longer having those conversations.
Yeah.
But I think 15.5 times earnings is probably fairly justified, because if it was priced at the same PE as other retailers, given the results it consistently puts up, the way it's gone about the online presence, building that, the online sales mix, and then as well, just the fact that it does have that optionality of, selling the software to other businesses that want to replicate what Next have done. It's got a lot more optionality as well, I think, than maybe other UK retailers. So yeah, I guess personally I'd prefer it was at those cheaper valuations that we'd almost gotten used to, but I can see why it does trade at the valuation it does.
Yeah, no, fair enough. Okay, on to another quality business.
Yes, and one that you own, I believe.
I do.
Okay, let's see how they've done. So Diageo have come out with their full year results, And all these figures will be in dollars, but they've reported full year net sales of 20.3 billion, and that's down 0.6% organically. Price increases of 2.9% were more than offset by a 3.5% decline in volumes, mainly driven by weakness in Latin America and Caribbean. Underlying operating profit came in 4.8% lower at 6 billion due to the decline in revenue and the increased investments in digital and marketing capabilities. Free cash flow improved by 400 million to 2.6 billion thanks to careful inventory management. Net debt rose from 19.6 to 21 billion. The full year outlook was uncertain, with Diageo saying when the consumer environment improves, organic net sales growth will return. Markets are currently forecasting full year organic sales growth of 3.5%. A full year dividend of 103.48 cents has been announced, which was up 5%, and the shares fell 7.8% following the announcement. So moving over to the Latin America and Caribbean regions, that dropped by 15%, and that's been put down to customers consuming less and trading down to cheaper alternatives. And this was one of the higher margin segments that the business operates in, or one of the higher margin regions, so it has had a disproportional impact on the profits. The near-term outlook for the region remains unclear, and that's why Diageo hasn't issued full-year guidance for the group, although the markets are forecasting organic sales growth of 3.5% this year, which I suppose would be quite good given the year they've just had. In terms of valuation, the business trades at a forward PE of 16.9 now, and that compares to a 10-year average of 21.3. And the prospective dividend yield is 3.2% compared to a 10-year average of 2.7. I think these results are disappointing, but there is going to be a degree of cyclicality of a business like this. It's not going to rise every quarter, but I think it's a very well-run business. It's a business with some excellent brands, and in the long term, I would still back it. I think even in the medium term, I'd probably still back it. I think these results are obviously disappointing, but equally, in the whole time we've covered this on the show, we've never seen it at below 17 times earnings. We've kind of gotten used to seeing it at around 25. So yes, the results are disappointing, but I think if you've had this on your watch list, I can't see it getting much cheaper. Famous last words, but I think it's a fantastic business. I think this is just a wobble. I think it's got some fantastic brands, and I think that will return to growth. I don't see this being a long-term problem. I don't have any concerns about the long-term future of the business. I think if you're someone who has been watching the business at 25 times earnings, I think it's worth taking another look now, because I think 16.9, I mean, it's cheaper than Unilever now. And I don't think we've ever seen that in the whole time we've covered these two businesses on the show. I think it's just by far the cheapest we've ever seen it. So how do you feel, John, as a shareholder?
Yeah, I mean, I think the results are disappointing, but they have consistently delivered over many, many years. And you look at the quality of the brands in the portfolio, and I think the overall strategy moving up the market to the more premium end and premiumizing their own sort of products and existing brands is the right strategy. It has been a very tough time in the sense that from a management point of view, the former chief executive suddenly died, and then they've had a slightly messy transition. So I think there are things that they couldn't have helped. And I would be optimistic for the longer term. In terms of the valuation it currently sits at, I think it is low. It's obviously, when we're talking about Next, it's higher than that. But when you're looking at some of the other companies that you mentioned, say Unilever, it's now less than that. And in terms of those brands, getting all of that for under 17 times earnings, I think it is very attractive. It's certainly one that I will be sort of topping up on now that it is lower, and that hasn't been the case for a long time. So yeah, I'm not unduly concerned, and I do think it's an opportunity from a value perspective to get in there and buy some more.
Should we move on to another business that may be an opportunity from a value perspective?
Well, yeah, it's an interesting one. Haleon, so that's the company that was spun out of Glaxo, it's sort of effectively their consumer health division. So it's got brands like Sensodyne, contained within it. We had commented at the time when it was listed, because or when it was originally spun off, because Unilever had come in for it and were looking at paying about £50 billion for it, which seemed eye-wateringly expensive. And when it came to the shareholders, I think, or the shareholders' opinion before it was even put to them, it effectively ended the then Unilever chief executive's tenure in that failed bid. But anyway, going on to Haleon itself, they've had their half-year results out with second quarter revenue growing by 4.1% organically in the first quarter, which was in line with expectations, with price increases contributing to most of the growth. And that brought the growth rate for the half up to 3.5%, with total revenue of £5.7 billion. Underlying operating profit for the first half was up 11% to £1.3 billion, reflecting revenue growth and easing inflation. Free cash flow more than doubled to £831 million, helped by the improved profitability and proceeds from brand disposals. Net debt came in at £8.4 billion, and full-year organic revenue growth guidance remains unchanged. Previous guidance was for growth in operating profits to outpace revenue, and that's now been upgraded to high single digits. The interim dividend was raised by 11% to 2p a share, and a further £185 million buyback was announced. The shares were up around 2% on the results. In terms of valuation, Haleon has a market cap of £33.5 billion and trades at 18.5 times forward earnings with a yield of just under 2%. I thought these results were very good, particularly considering how the sector has been doing. And I think you're seeing them consistently improve from Haleon, which is very positive. Historically, and I know it hasn't been listed for very long, they haven't been as strong as some of the competitors, but now they're coming much more in line with them. I think the debt, it's still on the higher side, but it's coming down, which is great. And valuation-wise, I would struggle to pay 18.5 times at forward earnings for it. I think in the sector, you've got a fair degree of choice. You've got Reckitt, which is having much more troubled times, which some might see a value play in. And then I think you've got Unilever currently at 18.1 times forward earnings. And I think Unilever, with the turnaround that's going on, and with the brands which I would rate over the Haleon brands being higher quality, for me, it would be Unilever every day. I think if you were also then maybe going back to more the sort of the value perspective, if you looked at how the price of Diageo at the moment, I know they're not exactly the same industry, but I think that would be, potentially appealing. So I think for those reasons, I wouldn't be going for Haleon. However, I think as a business and with these results, it's certainly looking like it's going in the right direction. So I don't think you can knock it in that sense.
I would agree. In fairness, when it listed, it must have been about a year ago now, but I think I maybe didn't give the brands enough credit, 'cause although they're not as good as Unilever's, I think there are still some good brands, and I think they've done well with them. I think I'd definitely rather have it over Reckitt, but for anyone who listened to the episode a couple of weeks ago, that's not saying a huge amount, given the state that Reckitt's in currently. That's not really a testament to the Haleon's performance. That being said, I think they've still got a bit of work to do. I'm surprised the valuation's still so high, given the results it's putting up. It's not putting up terrible results, but the valuation is high. I think if they can keep chipping away at the debt, and if the valuation were to come down at some point, I don't think it's a terrible business. I can see why someone might take a look at it, whereas a year ago, I don't think I'd have had that view. I actually think, having followed it for a year, it seems to be quite a decent business and probably has performed better than I would have expected in terms of like the growth and the operating profit when it first listed.
Yeah, no, definitely. Okay,
So,
on
sorry, go on.
to a company that you do own then, and that you do really like.
Yes, so Games Workshop, who I'm sure needs no introduction, but for anyone who's not familiar, it's the company that owns Warhammer, who do the miniatures. So they have come out with their full year results, and revenue was up 11.6% to 525 million, and that was split between core revenue up 11.6% to 494 million, and licensing revenue up 22% to 31 million. Core operating profit was up 17.5% to 174.8 million, and licensing operating profit was up 22.7% to 27 million. Operating profit overall was up 18.6% to 201.8 million. And that's operating profit of 201.8 million on revenue of 494.7 million, which is pretty good margins. The earnings per share is up 12% to 458.8 million. And the results do say in business model and structure, we are a vertically integrated business. We design, manufacture, distribute, and sell our fantasy miniatures and related products. These are fantasy miniatures from our sci-fi and fantasy universes. We are an international business centrally run from our HQ in Nottingham, with 78% of our sales coming from outside the UK. We have two main factories, a paint factory, two warehouse facilities, the Warhammer studio, and back office support functions, all are based in or near Nottingham. In terms of the store split, they have 548 stores now, and of those, 134 are in the UK, and it's down slightly actually from 135 a year ago. 185 out of 548 are in the US, and that's up from 172 a year ago. 162 out of 548 are in continental Europe, and that's up from 154 a year ago. Australia's flat at 49 out of 548, and Asia is up slightly at 18 out of 548, and that's up from 16. I think it's actually worth highlighting as well. I think the US store openings with 12 net new openings is positive. Given that 78% of the revenue is already coming from outside the UK, I think it does speak to the strength of the business, but I still think US revenue is 185 compared to UK at 134. When you think of the potential size of that US market and the potential benefits of the Amazon TV shows that will be coming out soon and what that could do for, interest in the brand, I think the fact that it's only, 50% bigger than the UK, I think sort of shows how big the opportunity is, because they could easily be at 400, 500, 600 stores in the US. I also think Asia is an opportunity potentially at 18 stores, but I think really I'd prefer them to focus on the US because that's probably where the richer demographic is if they can crack it, especially with that Amazon interest. In terms of valuation, the business it's been flat for, a few years now. So it's actually down 15% over 3 years. And I think that's more been a case of the business growing into its valuation, because it had an excellent COVID year, and then it had a bit of a poorer year after that. But then the last couple of years have both been really sort of very stellar results, I think. I mean, this year's, I don't think you can really fault. It now sits at a PE of 21.5. And that's not because it's particularly come down or anything. It's just it stayed flat for 2 or 3 years, and it's grown into that valuation more, because I think it was closer to 33 years ago. And the dividend yield's now 3.27%. As a shareholder, I'm very happy with it. And if it wasn't already such a large position, I'd be seriously considering adding at this valuation, because I'm not sure there's really anything to complain about in these results. And I think there's still a lot to look forward to and a lot of potential opportunity. And it's still only got a 3.28 billion market cap. So, John, what do you think as someone who has also followed the business for a few years but is less biased than me?
I like it more and more. I take your point in terms of how valuable the IP is, and that with the Amazon TV shows and it being at the moment much more confined to the UK market, huge amount of potential going over to the States and also in Asia. And I don't think really, even at sort of 21.5 times, it's not a lot for this sort of business. I think when it was 30, it did make me a little bit more nervy, but I'm much more drawn to it now that, as you say, it's sort of grown into that valuation. Yeah, so very, very positive on it, actually.
Is it on your watch list?
It is now.
Oh, very interesting. Should we move on to another business that I presume is on your watch list?
Yes, and oh goodness, this is one of the ones that sort of post-COVID, well, immediately post-COVID, it'd been on my watch list before, and then I never actually pulled the trigger on it, which I sort of deeply regret. And I suppose one of those businesses that, Buffett thinks is wonderful, along with your Visas and your American Expresses. But MasterCard, they had their Q2 results out last week, with second quarter results being ahead of market forecasts and net revenue up by 13% to $7 billion, ignoring currency movement. And this was driven by strong growth in transaction volumes across all territories, as well as cross-border payments. And revenue from the value-added services and solutions were up significantly, up 19%. Underlying operating profit was up 15% to $4.1 billion as revenue outpaced the increase in expenses. Free cash flow improved from $4.4 billion to $4.5 billion, and net debt came in at $8.6 billion. MasterCard returned $3.2 billion to shareholders through a combination of share buybacks and dividends, and full-year guidance remains unchanged, with revenue and costs expected to grow in the low double-digit rates. And shares were up around 3.5% following the results. In terms of valuation, MasterCard has a market cap of $427 billion and trades at 28.6 times forward earnings with a yield of 0.6%. I mean, I don't think you can knock these results at all. Revenue, given the size of the company, revenue being up by 13%, absolutely huge. And I think one of the concerns with MasterCard, Visa was the new sort of payment methods, and I suppose some of the startups coming through and competition rising, Apple Pay, Google Pay. But you're seeing, despite all of that, it's still able to do this. So I think it's a testament to the quality of the business and quite what a moat it does have. Difficulty in terms of coming and paying up for the shares, I think it's that valuation of 28.6 times, given the size of the business. I think that is ultimately what has stopped me from pulling the trigger on it over these years. I think when we saw it pull back a lot immediately after COVID, that was definitely a buying opportunity. I probably am not brave enough to pay that much for it, and that's often, and when we cover these sorts of businesses, where I get to with it. One argument, I suppose, with MasterCard over Visa is that it's more popular in some of the emerging markets and overseas, and there is potential for greater growth there. Whereas, I suppose, with both Visa and MasterCard in the US, it's pretty saturated. So despite it being 28.6 times earnings, I guess that's where the bull case lies for it. But yeah, and that's probably where I am, just not brave enough to pay quite that much for it. Sam, what are your thoughts on these second quarter results and MasterCard as a company?
Pretty similar. I think excellent set of results, especially given the size of the business, but same as every time we cover it or Visa. I just think the growth compared to the valuation, I feel like there's a little bit of a disconnect. I just wouldn't want to pay 28 times earnings for a business that's growing 13% a year, especially when I've got doubts that it could actually carry on doing the 13. I do find it interesting that the valuation is so high compared to, for example, PayPal, who we covered a few weeks ago, who have actually, in fairness to PayPal, put up pretty similar results. Guess you'd make the argument that PayPal doesn't have the same level of moat as Visa or MasterCard, and at least with sort of Apple Pay and Google Pay, they might be taking a slice, but a lot of the time you're still using your Visa or your MasterCard via Apple or Google Pay, whereas PayPal's getting completely cut out the loop. Yeah, really, really good set of results, really good business, but I wouldn't pay 28 times earnings for it.
Is there a price that you would be attracted to it at, or a valuation?
There is. I don't know what it is. If it was the same valuation as PayPal, I'd definitely buy it. But are we going to see it at 12 times earnings or whatever it is? Probably not.
Absolutely.
But I think I'd definitely buy it at that point. But yeah, I don't know where that figure is, but I don't really see anything that's going to bring it down. It's been expensive for a number of years now. And I know eventually if you wait long enough, you will get your chance. But, there's nothing I see. I don't really anticipate anything that's going to cause it any issues in the short to medium term. I think it's just one where we'll keep covering it every sort of 3-6 months and complaining about the price.
Yeah. Yeah, no, absolutely. Okay, then. Of the companies this week, what would be your first choice and what would be last?
I think last choice, if it was purely valuation, I think it would possibly be MasterCard. But I think given the quality of the business, I think I'd still rather own it over Haleon. Although I think that's a bit harsh on Haleon because they are actually, I think, a decent business moving in the right direction. But I think Haleon I would put last, but with the caveat that it's up against 5 really strong businesses this week. And in sort of most weeks, it probably wouldn't be number 6, but it is this week. In terms of number 1, I'll exclude Games Workshop on the basis that I already own it, but I do really, really like that valuation. I think Games Workshop excluded, I think it becomes quite an easy choice for me, and that it would just have to be Diageo. I think it's such a fantastic business with some fantastic brands, and I just don't think you'll get the chance to get it at 17 times earnings that often. It's we've been doing the show for, I think it'll be 4 years next month actually.
Gosh.
And we've never seen it that cheap.
No, that's true.
In the whole 4 years. And I suppose that we were coming out of the pandemic when we started, but yeah, 4 years, and it's basically been above 20 the whole 4 years, except for the last sort of couple of months. So I think it's a really good opportunity to get a very good business. So I think Diageo probably for me. What about you?
Oh, again, difficult. All very good businesses. I'd be tempted to say Games Workshop as the first choice. Valuation wise, and as a business, I do really like Diageo. I think the difficulty between those two at the moment is that it's at a very attractive valuation with Diageo, which you don't see every day. So I don't think I could really pick between those two, to be honest. If it was one I didn't own, it would be Games Workshop.
You say you couldn't pick, but Games Workshop you said is going on your watch list, whereas Diageo you said you will be topping it up.
Oh, yeah. Sam, putting me under pressure. I appreciate it's not consistent and it's not logical. I think it's easy. I think it's easier to top a business up. And when I say topping it up, I mean I've got a decent amount from dividends sitting in my trading account, which is easier to reinvest than it is to start a new position, I suppose. There's more commitment there. Yeah, but I take your point. Maybe I have to. Maybe before my trading credits come through this month on Interactive Investor, I'll have to go away and have a further think. In terms of what would come last, probably go for Haleon. It'd be a Haleon or Greggs, I think. But I think they're both not bad, and Greggs has certainly been doing well over the last few years. So that's probably how I'd leave it.
Right. I think that's everything in that case.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.